Please stand by. Good day and welcome to the Aemetis First Quarter 2020 Earnings Review Conference Call. At this time, all participants are in a listen-only mode. A brief question and answer session will follow the formal presentation. As a reminder, today's call is being recorded. It is now my pleasure to introduce your host, Mr. Todd Waltz, Executive Vice President and Chief Financial Officer of Aemetis. Mr. Waltz, you may begin.
Thank you, Melinda. Welcome to the Aemetis First Quarter 2020 Earnings Review Conference Call. We suggest visiting our website at aemetis.com to review today's earnings press release, updated corporate presentation, filing with the Securities and Exchange Commission, recent press releases, and previous earnings conference calls. This presentation is available for review or download on the aemetis.com homepage. Before we begin our discussions today, I'd like to read the following disclaimer statement. During today's call, we'll be making forward-looking statements, including, without limitation, statements with respect to our future stock performance, plans, opportunities, and expectations with respect to financing activities and execution of our business plan. These statements must be considered in conjunction with the disclosures and cautionary warnings that appear in our SEC filings. Investors are cautioned that all forward-looking statements made on this call involve risks and uncertainties, and that future events may differ materially from the statements made. For additional information, please refer to the company's Securities and Exchange Commission filings, which are posted on our website and are available from the company without charge. Our discussion on this call will include a review of non-GAAP measures as a supplement to financial results based on GAAP. A reconciliation of the non-GAAP measures to the most directly comparable GAAP measures is included in our earnings release for the quarter ended on March 31, 2020, which is available on our website. Adjusted EBITDA is defined as net income or loss plus, to the extent deducted in calculating such net income, interest expense, loss on extinguishment, income tax expense, intangible and other amortization expense, accretion expense, depreciation expense, loss contingency on litigation, and share-based compensation expense. Now I'd like to review the financial results for the first quarter of 2020. Revenue during the first quarter of 2020 were $39.5 million compared to $41.9 million for the first quarter of 2019. North America volume of ethanol sold during the first quarter was 15.7 million gallons compared to 16.2 million gallons in the first quarter of 2019, at an average price of $1.56 per gallon compared to $1.68 per gallon. India's biodiesel price was $786 per metric ton compared to $839 per metric ton, with tons sold decreasing to 3,554 metric ton compared to 5,182 ton. Gross loss for the first quarter of 2020 was $433,000 compared to a $351,000 loss during the first quarter of 2019. Selling, general, and administrative expenses decreased from $4.2 million during the first quarter of 2019 to $3.9 million during the first quarter of 2020. Operating loss decreased to $4.5 million for the first quarter of 2020 compared to operating loss of $4.6 million for the same period in 2019. Interest expense, excluding accretion of Series A preferred units in the Aemetis Biogas LLC subsidiary, was $6.9 million during the first quarter of 2020 compared to $6.2 million during the first quarter of 2019. Additionally, our Aemetis Biogas initiative recognized $960,000 of accretion of the preference payment on its preferred stock during the first quarter of 2020 compared to $449,000 during the first quarter of 2019. Net loss increased to $12.1 million for the first quarter of 2020 compared to a net loss of $10.7 million for the first quarter of 2019. Cash at the end of the first quarter of 2020 was $303,000 compared to $656,000 at the close of the fourth quarter of 2019. That completes our financial review. Now I'd like to introduce the founder, chairman, and chief executive officer of Aemetis, Eric McAfee, for business update. Eric?
Thank you, Todd. Aemetis was founded in 2006, and we've grown into 4 lines of business, focusing on supplying low-carbon and below-zero-carbon renewable fuels, biochemicals, and byproducts to markets including transportation, renewable natural gas, and carbon dioxide. Recently, we began shipping hand sanitizer alcohol and refined glycerin into the rapidly expanding antiviral sanitizer market. We own and operate production facilities with more than 110 million gallons per year of capacity in the U.S. and India. Included in our production portfolio is a 60 million gallon per year capacity ethanol, distiller's grain, and corn oil plant located in Keys, California, near Modesto. We also built, own, and operate a 50 million gallon per year capacity distilled biodiesel and refined glycerin biorefinery on the east coast of India near the port city of Kakinada. As you may know, high-quality alcohol and refined glycerin are the 2 key ingredients in hand sanitizer. Aemetis operates the largest production plant for high-quality alcohol in California and is one of the largest refined glycerin producers in India. The global COVID-19 crisis that began during Q1 2020 provided challenges to our business, including protecting the health of our employees while continuing to operate our California ethanol plant to supply animal feed to more than 100,000 dairy cows during a time period in which the demand for biofuels decreased significantly. Aemetis operates in 3 of the federal essential critical infrastructures and has continued to operate our California ethanol plant and the construction of a renewable natural gas project without interruption. To a large extent, the ability to continue to operate our California plant while fuel ethanol demand and price declined significantly during Q1 and then recovered recently in Q2, has been due to our rapid conversion of our alcohol production to produce hand sanitizer alcohol. In response to a severe lack of hand sanitizer, in late March 2020, the FDA and the Treasury Department issued an approval to alcohol fuel producers to allow ethanol plants to produce alcohol for hand sanitizers. We delivered our first sanitizer alcohol within a few days thereafter and installed upgrades to our California plant to produce higher quality ethanol for broader personal care and industrial markets. To our knowledge, Aemetis is now the largest producer of alcohol for hand sanitizer in the western U.S. In April, Aemetis received a distilled spirits producer certification, and we continue to invest in the upgrading of our production facilities to achieve U.S. pharmacopoeia and food-grade quality for our ethanol within a few months. Our expanding production of high-quality alcohol for the sanitizer market used for hand sanitizer, alcohol wipes, and alcohol sprays is expected to be a long-term growth market driven by the adoption of antiviral markets and products by governments, schools, private industry, and consumers. About a year ago, we signed a $30 million equity funding and launched a renewable natural gas project to build biogas digesters at about a dozen local dairies near our ethanol plant in California, construct a pipeline connecting the digesters to our plant, and install gas conditioning to produce carbon-negative renewable natural gas to reduce the carbon content of our ethanol production and to displace diesel by fueling natural gas trucks. We now have signed participation agreements with 17 dairies, built and tested 2 dairy lagoon digesters at a cost of about $5 million, and have designed and permitted a 4-mile pipeline that is now under construction to connect the dairy digesters to our ethanol plant. In 2019, we signed financing term sheets to fund an advanced ethanol production facility in California to convert waste orchard wood and other waste biomass into about 12 million gallons of cellulosic ethanol per year. We are now in the final engineering and procurement cycle prior to completion of project financing and commencement of construction of the plant. The combination of these growth and cost reduction initiatives are expected to increase our revenue to more than $500 million per year and annual cash flow to more than $130 million per year. This projected growth in revenues and cash flow reflects certain planned and completed upgrades of our existing plants, as well as planned completion of the new dairy renewable natural gas and waste wood ethanol production facilities. With the consistent support of California regulators and continued strong California low-carbon fuel standard credit prices, Aemetis has made positive progress in each of our 4 businesses during the first quarter of 2020. Let's first review our biodiesel business in India. After 2 years of investment and construction, we completed the upgrade of our India plant in 2019, including installation of a pretreatment unit to process lower cost and waste feedstock into oil. The biodiesel and refined glycerin plant is now fully commissioned using the new feedstock pretreatment unit, the new boiler unit, and other upgrades that enabled expanded plant operations toward full plant capacity of 50 million gallons per year. The stay-at-home order in India has restricted our production, but we continue to ship biodiesel and refined glycerin from inventory. This month, we expect to begin production at the India plant to meet expanding biodiesel and refined glycerin needs in India. Though the global price of diesel has declined along with the price of crude oil, the domestic price of diesel in India has remained largely unchanged due to the increased India government taxes that offset crude oil price declines. Since our biodiesel is sold at a price linked to India domestic diesel prices, our biodiesel prices in India have remained steady despite the significant decrease in the price of crude oil. In addition, refined glycerin prices have increased in response to the need for hand sanitizer and other consumer products. In May of last year, we announced that our Universal Biofuels India subsidiary was awarded a $23 million biodiesel supply contract with the 3 India government-owned oil marketing companies in a public tender process. Additional oil marketing company purchase requests for biodiesel have been issued for year 2020, and the award of supply agreements should occur in the next month. We expect to continue to participate as a key supplier under these biodiesel contracts. During the months of December and January, the primary constraint on biodiesel revenues growth in India is the seasonal colder weather from lower winter temperatures, and the high cost of feedstock in late 2019 has now decreased significantly. Our 3 businesses in the U.S. have achieved major milestones toward increasing revenues and sustained profitability. Let's review our California ethanol business. Similar to our strategy in India, where we added a technology to allow the use of a lower-cost waste feedstock to produce biofuels, we've been upgrading our Keys, California ethanol plant to lower input costs, reduce the carbon intensity of our biofuel, and significantly increase the value of the ethanol we supply to the 1.5 billion gallon California ethanol market, and now the sanitizer alcohol market. To produce higher quality ethanol for the sanitizer market, we installed carbon filter units and now are doubling the amount of carbon filter systems this week. We are also engineering and planning to install upgrades to our distillation system in order to produce high-quality alcohol that exceeds U.S. pharmacopoeia and food-grade standards in the third quarter of 2020. A second upgrade to the Keys plant has now been completed. In early May, we announced the completion of construction and commencement of commercial shipments of CO2 to the newly constructed Messer gas plant next to our ethanol plant to capture and reuse carbon dioxide. After 3 years of project development, Messer leased about 5 acres owned by Aemetis adjacent to the Keys ethanol plant to build a CO2 liquefaction plant. We are now converting more than 150,000 tons per year of renewable CO2 produced by our ethanol plant into liquid CO2 for sale to local food processors, beverage producers, and other CO2 industrial users. Ethanol plants produce about 40% of the CO2 in the U.S., so a significant national shortage of CO2 has occurred due to the shutdown or idling of ethanol plants. About $1.5 million per year of cash is expected to be received from CO2 sales and the land lease for the CO2 plant. We also expect to qualify for a CO2 carbon capture and reuse federal tax credit that we calculated is initially worth about $4 million per year and grows to $6 million per year over the next 5 years under the IRS 45Q rules. We are currently working on an arrangement to monetize the tax credits with a financial partner. The third upgrade to the Keys plant is the construction of an $8 million membrane dehydration system financed by Mitsubishi Chemical of Japan and a $1.5 million PG&E grant as a strategic implementation of the Mitsubishi ZEBREX technology for the first time at a corn ethanol plant. The Mitsubishi unit was delivered to the Keys plant in late February 2020 and is in the installation process. The ethanol dehydration unit is designed to significantly reduce petroleum natural gas usage and decrease the carbon intensity of our ethanol, and once implemented, is expected to generate an estimated $3 million per year of increased cash flow. A fourth upgrade to the Keys plant is a solar microarray and artificial intelligence energy management system that received an $8 million grant from the California Energy Commission. This solar system will decrease the carbon intensity of our biofuel through the use of solar energy to displace higher carbon energy sources. A fifth upgrade to the Keys plant is a high-efficiency heat exchanger project that was awarded a $1.3 million Pacific Gas and Electric grant. And the sixth upgrade to the Keys plant is a mechanical vapor recompression system that was awarded a $6 million grant from the California Energy Commission that is expected to reduce natural gas use significantly. These projects at the Keys plant are targeted to reduce petroleum natural gas usage and costs by up to 80%, while increasing the number of low-carbon fuel standard credits generated each year. The combined impact of these projects is expected to be a $30 million per year increase in operating cash flow at the Keys plant, not including any improvement in profit margins that are expected to occur if the EPA decides to enforce existing federal biofuels laws. Let's briefly review our Aemetis biogas dairy digester and pipeline project. Methane, commonly known as natural gas, is a potent greenhouse gas that is up to 30 times more powerful than carbon dioxide at capturing Earth's heat. About 25% of California's methane emissions are from the waste ponds on dairy farms. To reduce damaging methane emissions, in late 2016, California passed a law known as Senate Bill 1383 that mandates the capture of biogas from dairies. Biomethane sourced from dairies can be used to replace gasoline or diesel fuel in trucks and in buses to significantly reduce carbon emissions and air pollution. Along with the state mandate, California has funded about $75 million of annual matching grants to dairies to build biogas digesters and related systems. We believe that capturing biogas from dairies and converting it into renewable natural gas to generate negative carbon intensity biofuels is an excellent way to reduce climate change and create value for dairies while lowering costs for diesel truck fleets and electric vehicles. Based on our existing animal feed supply relationships with about 100 dairies and the ability to use biogas in our plant until utility pipeline approvals are obtained and pipeline injection is completed, we believe that Aemetis is uniquely positioned as one of only 3 ethanol companies in California who can use existing infrastructure in this manner. After more than a year of project development and financing work, last year we announced $30 million of equity financing and a grant award from the California Department of Food and Agriculture of 2 matching grants for a total of $3 million to build the first 2 dairies in our biogas project. Construction of the first 2 dairy digesters is now completed, and we are now building the 4-mile pipeline to connect the digesters with the Aemetis ethanol plant, with an expectation of beginning renewable natural gas revenues during late Q2 2020. We have signed 17 participation agreements with dairies and plan to complete construction of the next 15 lagoon digesters by approximately the end of the year 2021. Let's finish with an update on our below zero carbon cellulosic ethanol project in Riverbank, California. We were pleased that the Aemetis Advanced Biorefinery, under development in Riverbank, California near Modesto, was named as the #1 waste-to-value project in the world by Biofuels Digest, the world's largest daily biofuels publisher. The Aemetis project earned its #1 ranking as a result of our fixed-price, low-cost almond and walnut wood waste contracts for 20 years, with a cost of about $20 per ton for the first half of the contract period. Planned production of high-value cellulosic ethanol expected to be worth more than $5 per gallon, as well as valuable fish meal and other byproducts, and our use of the patented LanzaTech gas microbe ethanol production technology. The LanzaTech technology is now in full commercial operation at a plant that opened in 2018 in northern China that converts waste gases from a steel plant to produce ethanol. During 2019, we announced 3 significant financings related to the Riverbank project. A $5 million California Energy Commission grant to fund engineering and equipment, a $12.5 million tax waiver that offsets equity funding required for the project, and the signing of a $125 million U.S. Department of Agriculture conditional commitment letter for a 20-year debt financing under the 9003 biorefinery program. We are working to update the USDA loan to match the current capital expenditure budget for the project. We are focused on completing engineering of the plant required for the negotiation of the EPC contract that will include a bonded maximum construction cost. The Riverbank cellulosic ethanol plant is expected to generate more than $80 million of revenue and more than $50 million per year of positive cash flow by producing cellulosic ethanol from low-cost waste orchard, vineyard, forest, and construction demolition wood as feedstock. The financial closing to begin construction of the Riverbank plant is dependent on completing the engineering and procurement work required for the signing of the construction contract. In summary, we believe that Aemetis holds a unique position with the production of both higher quality ethanol and refined glycerin for the rapidly expanding sanitizer market. We also have diversified production of low-carbon renewable fuels in 2 attractive markets, in California and India. The profitability and 120% revenue growth at our India plant during 2019 was achieved while repaying 100% of our long-term debt in the India subsidiary. The increased margins from plant upgrades related to the Keys biorefinery are expected to begin to be realized in Q2 2020. The Aemetis biogas dairy digester and pipeline project is expected to begin first gas production in late Q2 2020. And our planned deployment of the patented LanceTech cellulosic ethanol technology at the Riverbank plant has positioned Aemetis to rapidly produce expanding positive cash flow from the production of low-carbon, clean-burning, high-performance renewable fuels from abundant, low-cost waste biomass feedstocks. Now let's take a few questions from our call participants. Melinda?
Thank you, Mr. McAfee. We will now be conducting a question and answer session. If you do have a question, please press star 1 on your telephone keypad to join the queue. If you're using a speakerphone, please pick up your handset to provide the best sound quality. Again, ladies and gentlemen, if you do have a question or comment, please press star 1 on your telephone keypad. And we'll pause a moment to assemble the queue. And it looks like our first question will come from Ed Wu with Ascendiant Capital. Please go ahead.
Yeah, thank you for taking my question. My question is on the biogas project. You mentioned that it's going to start up in late second quarter, which is, I guess, the current quarter. How quickly will that ramp up in terms of revenue?
We are going to have 2 dairies online, so our initial revenue would be a pretty rapid ramp to approximately 20% of our projected revenue for the project. It's about 18% of the projected revenue. And then as additional dairies come online over the next 18 months, we'll just be seeing a rapid ramp up. That rapid ramp up starts in early 2021, but we are awaiting an additional grant application we have filed that will we expect to have announced in September. Soon after that, we will be at full construction pace. There really will be nothing we're waiting for to complete the remaining dairies to end up with about a dozen dairies in this first phase.
Great. And then moving back to India, you mentioned that your plant has been, production has been suspended, but you expect it to resume by the end of this month?
That's our current expectation. They've relaxed a lot of the conditions, and frankly, they've approved the operation of our facility in India. So we're in the process of just getting things organized and back in production. The demand for diesel has increased nicely, and the price, of course, never really decreased. So it's an attractive market for us, and we're looking forward to getting production going again.
And then in terms of shutting down the plant and starting the plant back up again, is there any technical challenges with that, or is it as simple as once you start it, you will be able to get back up to full production pretty quickly?
Yeah, we actually have a maintenance cycle every winter already, and we already did the recommissioning So we're basically already through that process of being ready to restart. So it's a rather quick process.
Great. And then, pivoting back to, I guess, your ethanol plant, congratulations on being able to make the change into the, hand sanitizer market, ethanol production market. How difficult was it for you to be able to, shift from fuel ethanol into the hand sanitizer market? And have you completely shifted 100% of your business, or are you still selling ethanol into the fuel market as well?
The shift is very difficult for fuel alcohol producers to do because there's a combination of a variety of qualities that come out of a fuel ethanol plant. Nobody really cares what the odor of fuel ethanol is because you blend it with gasoline, obviously. And so odor matters a tremendous amount in this market, as well as there are some carcinogenics in fuel alcohol. Acetaldehyde is one that has been focused on by the FDA. And on April 15th, after about 2 weeks of operations by the fuel alcohol business, the FDA actually issued a notice stating that fuel alcohol producers could not produce for the hand sanitizer business, and unless they went through 3 steps with the FDA, which included disclosing the composition of their product. The FDA then went about closing down plants that had higher levels of acetaldehyde. It's a carcinogenic and obviously not a very good thing to have in hand sanitizer. So having consistent quality and being low acetaldehyde and other components that the FDA is not interested in seeing in hand sanitizer is not an easy task. It's one of our reasons why we have doubled our carbon filtering capacity this week, which is another substantial investment we've made, is to achieve what we seek to be, which is the highest quality alcohol fuel producer product, and then within the next couple months be in a position to be shipping the traditional FDA quality, medical quality, and food grade alcohol. So we're basically going through a process of a variety of changes that at every change improve the quality and consistency of our product, and by midsummer are seeking to be at very high quality products, which actually open up more markets even beyond sanitizers. So it's an expansion of the business into an entirely new industry that has been done and completed really during the stay-at-home orders. So you can imagine the issues of launching a new industry where you don't know who the customer is and conducting a substantial amount of transactions without ever meeting them. So we've achieved that and continue along that path.
Just for clarification, so is your ethanol currently meeting the FDA requirement, or will it meet later on?
We currently meet the FDA and TTP requirement that were issued for alcohol fuel producers. There's a separate set of rules that were in place prior to late March 2020 that we expect to meet over the course of this summer as we complete distillation system upgrades, et cetera. So then the temporary waiver, which ends December of 2020, will no longer be relevant to us. So our target is to try to be 6 months ahead of the termination of the alcohol fuel producer quality standard and be producing at the food grade standard long before other companies might have a chance to make the investments to get to this standard.
Great. That sounds wonderful. My last question is just on the economics. Is the ethanol that you sell into the hand sanitizer market comparable to selling into the fuel market?
No, it's definitely a different market. So there's a lot of price discovery going on in that market, and we'll see how it matures because it will continue to change as we go toward the USP and FCC grades. That's the pharmacopoeia and food grades. So we'll see over the next quarter or two how the pricing matures.
Great. And one last question, if I may, is just, love to hear your view on the oil market now. Obviously, it's changed a lot last quarter. So just curious about what's your current view?
Current view is that we're going to see a rebound in gasoline demand, which we've already seen, dramatic increases in any other market, but there was a significant decline. So the perception here will be of increasing gasoline demand. At the same time, the Saudis, I think, have finally figured out that they can make more money selling 6 million barrels a day than they can making 12 million barrels a day. And so with that constraint on the market and other participants in OPEC participating along with them, we saw the price of oil went from $12 to $25 in about 10 trading days. So my personal view is there's plenty of oil in the world, that there's shale oil available at $30 a barrel that will act as a lid on the market. And so we're probably in a $30 oil market for quite a long time as the Saudis and the Russians constrain production and the shale oil folks continue to produce. And so $25 to $30 oil will probably be here for a while. If the Saudis and others get serious about price of crude oil, gasoline demand is absolutely recovering. There's no question about that. And so sometime later this year, could be as early as the third quarter, but maybe the fourth quarter, the Saudis will be back in control of the price of oil. At that point in time, I would be not surprised at all to see a $40 to $60 price of oil. If the Saudis are very committed to this, they'll get a $60 price of oil by the end of the year simply by putting a crimp on the global supply of oil and forcing the shale guys to try to get more capital from the debt markets, which they will have a very difficult time doing. So the play for the Saudis is to bet that the shale oil guys can't keep on running their rigs, having scared the market so badly. And I think that bet will win. So if the Saudis are serious, we'll have $50 or $60 crude oil by the end of the year because the shale oil guys, which have to, they have 70 to 80% decline rates in their first year, they have to invest a massive amount of capital to keep drilling more wells. And we could see a rapid increase in the price of crude oil if the Saudis decide to.
Great. Well, thank you and good luck.
Thank you. I appreciate it. Thanks, Ed.
I apologize. Next, we go to Shane Martin with Stonegate Capital Partners. Please proceed.
Hey, guys. Thanks for taking my questions. A quick follow-up to, I think, Ed before me. It looks like less than 3% of your revenue was from that high-proof alcohol this quarter. And, again, kind of a quick follow-up. Can you give me kind of an idea on how much output you guys would be targeting there? And then also an idea of maybe some of your customers in that market. Is it several kind of intermediaries right now, or is it one singular purchaser at this time?
There were only, I think, 2 or 3 days in the first quarter that included alcohol shipments because the approval was on March 27th. And our expectation is we're going to have a blend of sanitizer product and fuel product until we get to a USP grade and FCC grade sometime this summer, at which time it's very possible that a large percentage of our product is actually going to the sanitizer product line, and a very small amount, just mostly for balancing, would be going to fuel ethanol. So I see it as a upward trend. We have had a dozen or more customers. Probably, if I look at the customer list, it's probably more than 15 customers. And so we do have some large customers, but we have an emerging market in which new markets are opening up for us that did not exist before. And there's entire customer bases that are coming from those markets, including international markets. So I expect that the business in the second quarter will be maturing with sustained high-quality product from us. And then the third quarter, when we hit USP, I think it's going to stabilize with a stable of probably 10 to 12 ongoing consistent customers. And much of our production would probably be going to that market if it matures the way we think it will.
Great. And then my next question is, you guys mentioned on the carbon dioxide capture system that it should benefit, about $1.5 million annually to you. Is there any sort of ramp up there? And then again, assuming that there's some sort of switch over into the alcohol market, would you still expect to have kind of that sort of annual revenue from it as well, or would it decrease or increase?
Good questions. The $1.5 million is under a long-term contract, and we don't expect that to change much. We do get an additional $4 million tax credit that we're working on monetizing. That grows pretty much every year for the next 5 years to a little over $6 million per year. And so the overall revenue opportunity here is in excess of $7.5 million per year. But the production of hand sanitizer or ethanol does not really impact the amount of CO2 we produce. As long as the factory is running at capacity, we produce the same amount of CO2. It comes off the fermentation process.
Okay, great. And then kind of switching gears over to the India side, can you give me a feel for what percentage of the sales volume decrease was due to the repairs that you guys have, just kind of general scheduled maintenance, and then what was attributable to the actual COVID-related shutdowns? Any kind of color there?
I would say repairs, which were completed in early February, would have not had much impact. It was the inability to restart in February and operate February and March that is largely the result of the volume declines in India. And so we would have expected to have a tremendous amount of product flowing in late February and all the way through March, literally at twice the rate of the prior year, if we would have not had this shutdown.
Okay, great. And then just last question, can you give me any color for this year on kind of working capital needs over this year, and then as well as any CapEx expectations that you guys have?
Working capital has been, on one hand, from operations, we're funding an increased amount of our working capital. We've been able to pay down several of our key vendors. India is already debt-free from a term loan perspective and sits on a substantial amount of cash. So we have, in California, kind of replicated what our status is in India and reduced our amount of cash that our vendors have extended to us, and in so doing have invested more in our working capital. But we've done that all through positive cash flow from operations. And we're expecting to fund our capital expenditures from a combination of three things: cash flow from operations, as well as the $21 million worth of grants we received, and the $30 million of equity that is already in place and has already been partially drawn. About half of it's been drawn already. So at the current time, we're fully funded for all of our activities except for the Riverbank project, which requires some additional funding, which we've described in our project financing plans. But the other activities we have are largely in place. I say largely because they're subject to future financings that haven't closed yet, and we always should throw in the COVID-19 conditions in talking about future financings.
Okay, great. Thanks for taking my question, guys.
Sure. Thank you, Shane.
Next, we go to private investor Tom Welch. Please proceed.
Thank you. Great call. Really only one question. Everybody else covered questions that I have. But do you have any future refinancing plan that you're working on that you can talk about besides the EB-5?
I would say that EB-5 had, as you saw in our earnings release this morning in the quote that I put in, it had a major breakthrough that should be understood by all investors. In the EB-5 program, there is a category called National Interest Expedite that takes what is otherwise a up to 3-year process of an investor getting their application reviewed, and then being able to move to the U.S. Down to a 90-day process. That's what the regulation says. And so to be sitting in India when a shutdown condition and have the prospect that within 90 days you could be approved to move to the U.S. and send your kids to U.S. schools and go spend time with your family members, it's a dramatic change in the attractiveness of our process. And we have had several hundred new interested investors happen. Each investor is $900,000 of investment, by the way. And so we, in our job studies, have 200 investors that we showed our plant qualifies for. And so if you just do the math, you could find it's a tremendous amount of capital for our business at 0.25% interest rate. And the first phase of our funding, which we raised approximately $35 million from, largely happened in 1 week. If you really are following the company, you notice that we went to China, and in 1 week, 2 sets of weekends, we oversubscribed that entire offering. It was a window of time in which things lined up, and though years had passed, we closed that largely the entire $35 million in that 1 week. This is not 1 week, but the pace of interest, the pace of excitement, the COVID-19 shutdown restrictions in foreign countries and how it's affecting people has definitely significantly increased the interest and the real activity of people investing. And so I think investors should be fully aware of its impact on the company. And those funds flow directly to the reduction of our senior secured debt, which is the bridge financing we use to fund these projects. Secondly, the financing of our Riverbank project, which has a USDA loan and also I've mentioned the municipal bond market, has a component of those proceeds that also reduces our debt by refinancing it into 20-year relatively low interest debt with no principal payments for a 2-year period. So that has the impact of reducing our expensive senior debt and replacing it with long-term, lower-cost debt. Other than that, we do not see the bond markets or the high-yield credit markets as being open to ethanol plants at this point in time. And certainly if it was, we would be very active there. But currently we don't see that those refinancing alternatives are available.
Very good. Just a clarification. The EB-5-2 financing was posted at $50 million, and yet I see that the minimum required amount has gone from $500,000 to $900,000 per investor. And there are, I believe, you're qualified for up to 100 of those units. So has the EB-5 Phase 2 financing gone from $50 million to $90 million?
We're actually in our what's called an exemplar. It's our business plan and project proposal that was approved by the government. It's actually 200 investors, but there's a function of the market, specifically the Chinese market, that used to be the most aggressive funding of this EB-5 set of projects, in which they wanted to have significant coverage because most projects never produced the number of jobs that were approved by the government. And so a project like ours with 200 jobs being created, 200 investors, EB-5 opportunities being created, when it's marketed in China, you would typically go out and say, we have 100 slots available, and then just increase the number of slots after those 100 are taken care of. We did that in our first offering and increased the offering by about 20%. The Chinese are no longer in this market, really. It's now primarily Indians and other countries. And because we have a plant in India, we have a lot of credibility compared to other project developers. And because we completed our first project, completed all the jobs, actually exceeded the number of jobs we originally projected, and all those investors have now been approved and many have moved to the U.S., we're considered to be a proven developer, which opens up the opportunity for us to do 200 investors because we don't have to market the idea that we might not achieve the number of jobs available. And at $900,000, that's an additional amount of funding that isn't under the more conservative model. So we're going through a gradual process of obtaining investors, filing with the U.S. government, doing the amendments as it grows, and the project is under construction. So you create jobs as this happens, which continues to build confidence. So we're seeing a replication of what happened last time, but this national interest expedite was an effort that took us about a year and a half and has now succeeded. And we, I believe, are the only national interest expedite that we know of that's been approved for the last year or so, except for a casino in Guam. And it was considered to be in the national interest because it was an entertainment facility for military personnel that didn't have a lot of alternatives in Guam. So they got a small amount approved as national interest expedite. So it's a major breakthrough that we worked on for more than a year and a half. In spite of many, let's call it rejections, we were successful in getting that achieved.
Very good. That ends my questions. Thank you.
Sure. Thank you. Appreciate your time.
And we take our last question or comment from Massimo Fiorella, private investor. You may go ahead.
Hello, Eric. So first of all, I want to make my compliment because I heard that you have become the first producer of ethanol for hand sanitizer in the Western United States. That is, according to me, a big achievement because I read that other companies were halted production by FDA. I just want to know a fact because I did some research and I saw that like ethanol for fuel were sold around $1.5, $2, something similar. And hand sanitizer is sold like $50 per gallon, $100 per gallon. So I wanted to know, like, doing some math of how many gallons for ethanol for hand sanitizer you ship each day, and if the number that I give you are realistic or are they are too much.
Thank you, Massimo. Good to hear from you. We are definitely getting a higher price for the sanitizer market than we are getting in the fuel ethanol market. There's a lot of price discovery going on in the marketplace, so the range of prices is quite wide. You mentioned $50 to $100, and actually that's true. At retail, even discounted pricing is considered to be reasonable if it's in the $30 or $40 range, and there's many prices that are in excess of $100 when you're buying it in a smaller product sizes, such as 2 to 4 ounces. But this is a market in which we are a major player in the Western United States, and we entered the market as a supplier of just the alcohol itself. We see the market maturing, in which we're partnering with major customers to make them successful in the market, and that's really focusing on quality. So I think we're at the phase in which upgrades to our plant and our ability to sustain high quality will have a big impact on our ability to continue to supply the marketplace and continue to be a leader. So we'll see as this quarter completes and we report our financial returns how that market matures. But I really do think that the third quarter is when we become a regular player because of the USP and FCC grades that we expect to be shipping at that point in time. Until then, we're in a transitional market with a lot of up and down in terms of customers' desire for product that really the alcohol producers don't make. And so it's a transitional quarter we're in right now. Regarding our number of gallons, et cetera, it's very, very volatile. So we will get to the end of the quarter and then report what it is. And I think it's one of those things where you get out and you ship a lot of different customers and learn a lot about the market. And we've done that very successfully. And then in the third quarter, I think we're going to stabilize by focusing on a small group of maybe a dozen customers and longer-term relationships that are coming out of that.
But as of today, like how many gallons do you ship, like as average, more or less?
Yeah, it's pretty volatile. So day-to-day numbers are all over the place.
Okay, so another question that I want to ask you, it's about the $1 listing rule about NASDAQ, because we have time to comply until end of July, and according to me, it's fundamental that Aemetis will be compliant with this rule, because according to my opinion, it's very important that it will be listed on NASDAQ. Also related to this question, I was thinking that as of now, the market capitalization is very, very low. It's $15 million. It's like something like very cheap. So if you commit like, for example, $5 million, it means that today's valuation, you can buy back like 30% of the share. Since the future, according to me, will be bright, because, you know, in May or in June, people will start to drive again. So the gasoline demand will be up. So ethanol will be up. There are a lot of new projects going online. There are the hand sanitizer, all these kind of things. I was thinking that, according to me, the best investment that can do Aemetis is to invest on itself and to start a buyback program. What do you think about this one? Do you think that is feasible? Do you want to do this one?
NASDAQ
the last question concerns to this one. What is the plan to be listed in the NASDAQ and to achieve the $1 valuation?
Right. NASDAQ has extended our time window past the original time period by an additional 90 days. They have a large number of NASDAQ-listed companies that, due to the COVID-19 crisis, would be delisted off of NASDAQ. So they have extended it voluntarily. We didn't apply for that or anything. They just gave us an extension. So we're talking about approximately late August or so, and we can apply for an extension after that. So we're not currently concerned about the dollar price. We think just our performance will solve that pricing issue.
Okay. And about the buyback, do you want to comment anything? Do you think that it is feasible?
I'm sorry, say that again?
The buyback, do you think, because in the last months, like in the last year, other competitors like Green Plant started a buyback program. According to me, it's also a good option for Aemetis. So I wanted to know if there are any chance that Aemetis can do a buyback.
A buyback of shares is absolutely in the shareholders' best interest at such a low stock price. We think the market largely doesn't understand what's happening in the fuel ethanol business, and then, of course, in the case of Aemetis, doesn't fully comprehend the positive impacts of a number of things we're doing. But I think they will come to understand it as they see the combination of increased cash flow from operations and a refinancing of debt. So our expectation is at appropriate time that a stock buyback would absolutely be in the best interest of shareholders, and we are considering that as our board of directors looks at shareholder value increases that we could achieve. Certainly a shareholder buyback will be something that would cause a tremendous amount of shareholder value to be created. We're buying their shares at extremely low prices.
Okay, thanks a lot.
Sure. Thank you, Massimo. Good luck with what you're doing in Italy.
Thanks.
There are no further questions at this time. I'd like to turn the floor back over to management for closing comments.
Thank you, Melinda. I appreciate it very much. Thanks to Aemetis shareholders, analysts, and others for joining us today. We look forward to talking with you to continue our dialogue about the growth opportunities at Aemetis.
Thank you for attending today's Aemetis earnings conference call. Please visit our investor section of the Aemetis website, where we will post a written version and an audio version of this Aemetis earnings review and business update. Melinda?
This concludes our teleconference. You may disconnect your lines at this time. Thank you for your participation.